South Africa's mining industry has faced a tough year, and that on the back of recent industrial action, mounting cost pressure and shrinking profit margins. The top 39 mining companies shared all gains made since the 2008 financial crisis and saw market capitalization weaken by 9% to 833 billion rand from the previous year. Hein Boegman, who's a mining industry leader for Africa at PwC, joins us now for a look at trends that are fast emerging within the mining industry space. Thanks so much for joining us this afternoon. Let's get straight into it. As I read there at the top, Hein, mounting cost pressure with shrinking profit margins, pretty much that being used right now to characterize the South African mining industry and working to deter investors to quite a degree. PwC's issued this report. Broadly speaking, is it a fair characterization?
I think broadly speaking it is. If you look at the year past, it wasn't that bad. Certainly we've seen a retraction of market cap that it's sort of developed over the period of time since 2008. But looking forward, we are particularly concerned in terms of the margins out there. The cost pressures are big, and it's not only wages, it's utilities, it's the general upward curve of mining cost worldwide and in South Africa. And then, of course, it's always the rand basket price of commodities versus the exchange rate.
Hein, given the nature of the strikes that we've just endured and are still enduring in South Africa and various sectors of the economy, but let's focus specifically on the mining strikes. Given the nature of those strikes, given the response of the mining houses, do you think that this is a once-off event, or is this something that you're factoring in that is going to be a part of the mining life in the future of South Africa?
That's a tough question to answer, but certainly I think in terms of the way mining houses are looking at the risk, it is certainly different from the way it was before. It is not only safety risk and it's not only environmental risk. The risk is now across a much bigger focus area. And perhaps there's some lessons to be learned from the financial services sector, where the risk manager would sit at a much higher level and somebody that would perhaps report directly into the board or at executive level. Certainly we saw from the events that there's perhaps a need to be more directly engaged with what's out there in the market, and perhaps not to be over-reliant on some of the structures that is available within South Africa to look through as to what is really happening in the communities around you.
What that context has done is really refocus mining companies and their agendas. I mean, I was reading in the report that we've seen a significant increase in the assets held for sale, and that indicating a trend in itself that non-core assets are being hived off, and that as companies start to prepare for leaner times ahead.
Yeah, I certainly think that goes back to your first point, which has to do with cost. We've seen some assets held for sale. In some cases, it's just corporate activity. If you look at Exara and you go and look at Northam and some of the others where we've seen this change. But in some cases, it perhaps is a question of looking at a leaner ship. And when you look at the 39 companies we interviewed in the last, or that we surveyed, at least 2 of those companies are not with us anymore at the moment, one having mothballed all its assets and the second being under judicial management as we speak.
Mm-hmm.
You sound a little bit gloomy, Hein, I must say, and I suppose in the current environment that's completely understandable. It's not easy for somebody to say, well, I'm not going to dig platinum out the ground in South Africa because I'm going to go and dig it out in Madagascar or something like that. It's not the case, because we have the resources under our feet, which is absolutely fantastic. We haven't leveraged enough, I don't think. We haven't taken advantage of it. Do you get a sense of despondency, particularly from overseas investors, about the way South Africa is handling its mining industry? And certainly in the short to medium term, is that despondency justified?
I think it's fair to say that recent events and the downgrading of the risk rating in South Africa has generally had an impact on the cost of capital and therefore the attractiveness of the South African destination, if one can call it that. I wouldn't say a despondency. I still, as you say, 70% of those resources, especially in the PGMs, still sit in this part of the world, between ourselves and Zimbabwe. And certainly there's not a viable alternative to that available at the moment. And if you look at what the government is trying to do, it is trying to take us up that value curve. But certainly recent events have been damaging to the country, and it's interesting to see that Minister Shibongo is out in the US as we speak, if my recollection is correct, trying to calm down investors and to give a balanced view as to what is available in this part of the world and what the risk appetite should be.
With that, I mean, what kind of investments are you seeing being made? Because, you know, I highlighted the fact that we're seeing a selling off of non-core assets. Having said that, the commentary that's come in this report is also that generally balance sheets in mining industry remain strong for the 2012 period. So that means that there is capital there. It's just looking for a place to go.
Yeah, I think certainly so, but you need to maybe just also take into account that the mining companies have historically been fairly lowly geared. Then looking at the situation in 2008, where perhaps not of a particularly high base, gearing actually went even more positive or negative, depending if you're in the banking industry or not. But certainly the balance sheets became pretty strong in terms of taking on some of these activities. I think there's the balance that needs to be played out between capital and understanding that this is a wasting asset, and it's something where you continually need to develop the next ore body, the next shaft, etc. And that's something that's quite often misunderstood by labour and by those looking at those balance sheets, that these companies are in it for the long haul, and therefore it is important that they keep those balance sheets strong, also to weather the storm through what would probably be a tough time coming up. To answer your direct question, I'm not quite sure if I can tell you where the next investment would come into South Africa, but we certainly hope that with more certainty past the political convention at the end of the year as well, that we'll see a return of good interest into the country.
Out of adversity, often, Hein, we get innovation, and we're going through a particularly dark time in South African history at the moment, specifically linked to the mining industry. But in the future, of course, when costs come under control and when labour relations are renegotiated, if you like, in the future when the commodity prices continue going up, because obviously they will as the world's population grows, then we will be in a better position to take advantage of them because of the lessons that we're learning right now, I would have thought.
Yes, I certainly think so. And one of the lessons I think we should be looking out to learn is, as the labour cost increases, and perhaps rightly so, one needs to just understand that something needs to give. And in this case, hopefully it's a realization that productivity is part of what is necessary in this industry, and an industry in large, to be competitive in world terms. So I certainly hope that, you know, through the bitter experiences and the tragedies that we've had, we come out of it stronger, as you rightly said.